All right, well, stock started the week on a really good note, really solidifying this breakout that from pretty much from the CPI report on. Actually, it was from a couple of earnings reports before on the same day of the CPI report. The stocks were already doing pretty well in the pre-market, and then the CPI hit, and it really did well. So things that that it's been a really good few days last week, and then today continuing and really solidifying, like I said, breaking through and showing some very strong bullish patterns. And again, I described this volatility storm that's been settling in here at the end of the last couple of weeks with a pretty sharp negative correlation divergence between volatility, VIX, and its volatility, right? The volatility of the VIX. And so far, it appears that this storm may be passing through without producing any significant tornadoes or any spikes in volatility is the analogy I like to use there. So far, we're looking really, really good. And so I'm going to break down why it looks so good and what kind of drove the pricing today and whether or not the today's asset class movement and sector movement kind of matched up with the bullishness that we have seen and continue to see really over the past 4 sessions. I'm going to break that down. And then we're going to take a look at another good bullish trade idea that should benefit from a renewed bullish trend, long-term trend that takes us up through into 2 new highs and then through them by the end of the year. So let's go ahead and get started. Today is Monday, August the 15th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started really quick, I invite you to subscribe to our YouTube channel, like our video, click that thumbs up icon down there. Also comment on the video what stood out to you while you're down there. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on over here, and then you can come down here, click on this heart. It opens up this tab, hit that like button. Also the same thing here, click this thumbs up icon, click that like button. Again, the more you do that, it helps get our content out to all of our followers on these social media platforms. All right, well, let's look at the S&P 500 here with the market forecast indicator. As you can see, we have a strong bullish posture still in the 90th percentile. Very, very good long run, longer than what we've had since October of last year, when we were just a smidgen under 90 for a couple of days. Otherwise, we were, for a few weeks, pretty much an entire expiration cycle. We were up above the 90th percentile. So it appears that that's going to be this expiration cycle that we're going to be up above the 90th percentile. We're really working our way up towards getting above the 62% retracement of the screen lines. We've really cleared this 3 pronged resistance area here, 23% from the post-COVID low, 50% retracement of this long-term decline, market sentiment decline, and then the 62% retracement of the current intermediate decline. So good break above. Now we're heading up towards this 43.70 area where the 62% retracement is of that long-term decline, which is really the last single little area of resistance we have left, and that's about it. Good strong run here. Momentum lines back in, so you had all 3 lines in bullish territory. You didn't have them in the upper reversal zone, but you did have them all 3 in bullish territory at least, and you tend to get that. You can see, for an example here, once we did get into bearish territory, we had all 3 in bearish territory or bullish territory there. We had all 3 in bullish territory. I guess that would be the only other time, and this would be the second time that we've had all 3 in bullish territory. But of course, we still haven't got a cluster yet, which is getting all 3 up above the 80th percentile. We are still at the highest level of the 30-day moving average for the past year, 7.14%. In fact, I think it's for the past 2 years. This is the highest. Yeah, this is the past 2 years we've had the highest. Over here, when we really went parabolic, we were only 6% up above the 6.3% above the 30-day moving average. That was there in September of 2020. And that's when we really kind of dropped off. So we're higher than that now. Of course, we're coming off of a low point where we were about 8% below it. So makes a difference. And on an oscillator like this, it will swing down, swing up to its highest levels typically when you're coming off a pretty significant low level, in this case a cluster. Remember, we also got the cluster on the weekly chart there as well. So it's pretty bearish on that particular session. And again, when you look at the weekly chart, there was that cluster there in June, heading into that weekly low. So here's there's the cluster here on June 17th. So that would be the end of that week of the 12th. And then if you look at the June options expiration date, we didn't quite have a cluster, but you can see that's when we had about as oversold, because it started in May, right? So that was about this oversold short-term sentiment that we've had combined in a while. The intermediate line obviously is there, but we're having a really good run now on the short-term level on this curve. Look how bullish we've essentially just completely reversed where we were going into this April, the expiration cycle that ended in May. We've really made a round trip, and your short-term sentiment now is up in bullish territory there. And I mentioned last week this bear tag, and so far so good in terms of not reversing it, at least in the first week. Obviously in the first day of the first week, coming off of that. So pretty bullish. We maintained the bullishness. The near-term line, really high levels. The highest level for the NASDAQ since way back here on the 29th, on March 29th. The highest level for the Russell 2000. The Russell 2000 got all the way up to 99.3. So you'd have to go way back to get a higher level than that. So really high. Again, the past year we're right at the peak, the highest we've ever, highest we've been. We are above the 38% retracement. We are above the 62% retracement. We are above that 23. So this was a really important line for the Russell 2000 to clear last week, and we did, and it's so far holding it very well. And your NASDAQ 100, same thing. There's that three, a little bit separated, but those are the same three lines, adding in the 50% retracement of this decline, and you can see so far we've held the breakout. Right, so far, looking really good there. We are running into that 62% retracement on the intermediate basis there that we have already cleared on the S&P on Friday and held it today. So we're looking really good here from a bullish standpoint of clearing these resistance levels and really getting going to the upside. When you look at the long-term charts, again, we're closing above the 200-week moving average. We closed above it last week. Now we're easily above it. Now again, the week's not over, but as of right now, we have a very strong weekly close on a Hakinashi basis, that is, above the 200-week moving average. Rising PPO, positive differential, very bullish from that perspective. The NASDAQ 100 is also this week cleared the 200-week moving average, and then the Russell 2000 again on the Hakinashi basis, which is the average of the open, high, low, and close. And you can see the Russell also really clearing this, looking really good, about as good as you could possibly be. From a 3 green arrow standpoint, again, good 3 green arrows still, and your MACD is rising. The histogram is rising again. It was really close to a red arrow. Not one of the major indexes eventually got the red arrow. They all turned back up again, and they're all off of that. So, and the MACD is getting bigger for all 3 of them. So 3 green arrows still maintaining very bullish posture from that standpoint. You can see we are way up above like 30, 50-day moving averages here. It's been a while since we've been this bullish from that perspective. And you can see the 30-day has crossed above the 50, and that's also a good sign too. When you see the 30 crossing above the 50, you tend to get a little bit of a pullback towards the 50 after, or at least back to the 30 after you get that bullish crossover. Let me show you an example. Okay, so over here you can see the 30 crossed above the 50 over here, and you can see we made a run back to the 30 and just a couple of days. It wasn't very big, but a couple of days down to the 30, broke the 17, and actually made its way down to the 50 on an intraday basis. If I were to go back to, let's go back to 2019, you can see once we got the crossover of the 30 over the 50, then that's what we kept going up for a while. Then we got some weakness down to the 30 multiple times. So we are pretty far above the 30 right now. So this is, like I said, one of the bigger moves above the 30-day moving average that we've seen in a while, outside of course of the COVID move, right? And when you look at this would be the 30 here. Let's go 30 simple. We're 7% up above. You can see that's pretty close to the COVID move, but we haven't had any. We've never been, outside of again that move. 7.22. So put this right here. So outside of the COVID rally, where we were coming off of being 20% below the 30-day moving average, you'd have to go out here to July or 2011. We got 8% up above. For a couple of days, we were 8% up above. So again, that was right there and got us to the 200-day moving average, kind of very similar to what we're seeing right now, because right now we're getting up to the 200-day moving average. So just like 2011, we had this strong rally that got us to the 200-day moving average. A little bit of a pullback afterwards. Did not get to lower highs, or lower lows, excuse me. Did not even retest the low point. Just came back down below the 50 briefly before we finally made our way up off that low to the upside. But that move, coming off of that washout low point, got us this high above the 30. And then again, you had to go all the way back again to 2009 when we were coming off of major pullback, like big bear market pullbacks. We were 14 to 25% below. Obviously, we're not 14 to 25% below. We were only about 7, maybe 8.5% below the 30-day moving average. So needless to say, pretty tremendous rally. You also see that too in the whole moving average. I tweeted out today, this is the biggest that we've been above the whole moving average for a very, very low, the 200-day whole. And again, if I were to throw on, I tweeted about this for those that follow me on Twitter. If you were to look here, again, there's your COVID response, and again, we were down 30% below the 200-day whole. So we are not down 30% below. We were down 10% below this go around, but we were down 30% below, and we got up above the 200-day whole. Remember, the 200-day whole is kind of like an exponential. And then over here, you got well above the 200-day whole. It was still red at the time. Over here, it was green when you got above it, and that ended up being the low point. And again, you were coming off of 23% below the 200-day whole at the time. So the worst we got again was 7% below, and yet we are 12% above. So we've really kind of swung a lot further to the upside than we were down to the downside, and that's really kept us up, really pushing us up to higher highs, higher Hakunashi closes. And the parabolic SAR is still negative. The Hakunashi is 20 days still green. So it's been a really, really tremendous move. Your directional movement index is easily above 30, easily below 20. ADX is rising, so that's a good sign. That's a very strong bullish pattern there. When you're looking at the Bollinger Bands with the Keltner channels, we're just riding right in between them. It's a very, very good sign, up in the upper quartile of the bandwidth. I mentioned the need to break out of this trend. We have to get above 70. Just like you'd have to get below 30 to break out of the bullish trend that we were in. So we did. We got up to 72. First time in a long, long time, that we started the trend, right? When you go back to COVID, again, you can see when we were that bearish and it took a break above 70 to change the trend. We've been bullish in a bullish trend ever since. And then there's 2018, right? Took a good move. We didn't quite get all the way up. We got up to 70.18 there, coming off of that low point. So this is obviously a lot clearly further up above 70 when you get, when we're up there at 72. And then finally the Ichimoku cloud, up above 5 easy, up above 80 easy. So we have a very strong trend. And we're approaching the green switch over, and we're going to be easily above it unless things really drastically change, which is very unlikely. We're going to be easily above that green area by the time we get to that spot, which would be a very good sign in terms of a change in trend. That remember, the green is this breakout shaded forward by 26 days. That means we're still holding the trend 26 days from now if we're able to stay above the cloud. So all good signs all across the board. Looking at volatility, volatility was down, was up today, but only because it gapped up, right? It was down throughout the day. And like I said on Friday, we're 8 weeks in and we're going for a 9th week of declines on volatility. So not quite there yet. We have to get below 1953 to close below where we are. You always gap up if you were to look at the VIX. Let's see here, where is this chart, and then look at the VIX, and then let's look at it on a weekly basis. You can see we almost always gap up, and we did this week too. That's just the way volatility works. It's very rare for it to gap down. It almost always gaps up, but if you notice, it almost always finishes lower. There's a few periods of upward movement, but we've had 1, 2, 3, 4, 5, 6, 7, 8 weeks now of volatility moving to the downside. And you can see when I look at it on a options expiration cycle, which we're about to end right now, as I mentioned last time, this is 2 really strong consecutive options expiration cycles of 20% or more declines, which is not very common to get that much of a decline. So looking at it on a quarterly basis here, this is the current quarter that we're in right now, and you can see there's been some good negative quarters in the past, and we're down 30% already this quarter, and we still got about another month and a half to go. So good moves to the downside and volatility. You expect that it will continue to be the case, even if we're still we're only at 85%, so we can drop down to that 80% mark before we finally get a little too oversold. So that's the VIX. The VVIX, which we talked about, that negative correlation on Friday, it pulled back down today. So if they both end up going lower, then the storm that we talked about on Friday can pass through without producing a tornado, if they can both end up going low. Now, VVIX doesn't really have a whole lot of room to go down, but it has in the past gone down to over here down into the 60s, right? So back in 2014, now you had QE3 going on during 2013 and 2014. So it kind of helped keep volatility in check, and we don't quite have that now, but there's precedent for the volatility of the VIX to get a lot lower, which means the ranges, how big the moves are in volatility in the VIX will get really small, and generally is to the downside, because the moves to the downside are smaller than the moves to the upside. Alright, let's take a look at the intraday range here, and you can see a higher high and a higher low. We closed above yesterday's high. Very, very good. We still haven't closed in that gap on August the 12th. It doesn't mean we have to close it in a day or two, but you still consider at some point in time, and maybe on any kind of near-term decline where the near-term line works back down to bearish territory, you would expect at that point that you're going to fill that in, that would be a common gap. This is the one that's got the potential for a breakaway gap from last Wednesday, but this one, like the one before it, you would expect it to be filled, considering it's more of a common nature. And then finally, the last thing I wanted to look at was today's volume and range. The range came in below the average. The volume came in at 54 million. So when you look again, when we look at the short-term moves here on the money flow, which looks at the volume for SPY, but it multiplies it by the price, then you can see we're not quite up above this peak from July 29th, even though the price is well above that. So, it's one thing for the unbalanced volume not to be above it. It's another thing for the money flow not to get above it. So this again gets to show that there's been, in these 6 out of 7 down days, which weren't very big, there was more volume on those down days than there has been on the 1, 2, 3, 4, 5 up days, right? Even though the 5 up days were much bigger moves to the upside than the 6 down days were to the downside. The volume hasn't been as good, hence we're not up above. We are getting close to at least being above these highs, not quite. Set minus 687 there, minus 702. We're still at minus 711. So we're getting really close. What's also getting really close too is the new highs and new lows. We were briefly up above 100 before. I think it was the NASDAQ that came in, because this measures both the NYSE and the NASDAQ. So we're positive, or we're positive 80. So we were almost up above 100 there. And the other thing too, from a breadth standpoint, that's really close to being just, great positive number, is we're at 790 here on the McClellan Summation Index. So not only are we above 500, but we are that close to getting above 1,000. And again, once these moves that get you to 1,000 or more coming off these major lows pretty much are set now for however long the continuation of that trend lasts. So we never did get above positive 100, but obviously it doesn't really matter. It hasn't been necessary because we never did get below the minus 100 level, which is kind of surprising considering how big the pullback was, but this correction was. But it goes to show that again it was just a correction, just like on the VIX not getting above the 1.25 level compared to VIX 3M. This goes to show that this is probably not as bad as what a lot of people paint it out to be. That it's only as bad as it was because of how bullish we were going into this peak. We were tremendously bullish. But from a linear regression standpoint, let's go out to like a 10-year basis. From a linear regression standpoint, we had pulled back down. We never did get below any of these standard deviations, one or second, like we did in that one, like we did in some of the others. Right, even in 2015 and 16, which would probably be the kind of a more weaker ones. If I were to come over here to say 2. And go out a year before that. No, it'd be 10 years before that, sorry. So even 15 and 16, you notice, kind of similar to this one, basically got us to the midpoint of that linear regression trend line, and in turn, it's obviously already pretty high. And then when you go out and look at linear regression on an even longer term basis than that, just like that, we're back up to the 1 standard deviation level on the 20-year linear regression. So the 20-year trend line right now would have us at $339 a share, and we're almost $100 above that. So just like that, that's how strongly bullish we are, again, on a long-term basis. Remember our long-term valuation metrics here on the CAPE ratios, above 32. So we're coming off of a major low point, but we're already pretty darn bullish to begin with here on this little rally. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below and tell me what you're thinking about how bullish we are right now. How likely are we to get to new highs by the end of the year? A lot of these indicators are telling us it's very likely. Do you agree with that? If not, what charts are you looking at that would tell you otherwise, based off of past precedent, of course? So share with those charts down below. Okay, now let's take a look at what's driving this price action. You can see biggest mover today was the dollar, interestingly enough. Gold and commodities are down. Of course, you'd expect that with a really strong day on the dollar. Gold and commodities are both lower. International stocks also, you'd expect to do poorly. U.S. stocks are okay. They outpaced bonds, they outpaced corporate debt, they outpaced gold and commodities. They did not obviously outpace the dollar. And the Qs really did well too. Outperforming and beating IWM for the first time in a while. Let's take a look at some of these charts here. Let's take a look at the dollar yen. That's where the yen is our safety trade. You can kind of see how the yen is doing here. A little bit of a down move on the dollar there against the yen. So you're like, oh, how did the dollar do so well then? If you look at this, let's look at it this way. This would probably be a better way of looking at it. And then go down to just today, August the 15th. Here we go. So there's the dollar up against the euro, not very far up against the yen. Yen is safe haven, and the franc also safe haven. So the franc and the yen actually outpaced everybody except for the Mexican peso. But all the commodity currencies are down here. The European currencies are down here. The pound down here. So the dollar did very, very well. It did really, really well against the euro. But the euro just really came in again below just about everybody else. Again, you look at the euro US dollar currency pair, and you can see it dropping back down below, all those moving averages, getting back below the 30-day moving average. And remember, again, for most of this year, that's been coinciding with bearishness in the markets, and this move off of the mid-June, there's your mid-June lows in the stock market. The euro did falter down to lower lows in July, but pretty much stayed right around break even, around the same level before this recent little downturn. I also mentioned long-term bonds, because bonds also fell a little bit today after gapping up pretty sharply. You can see this move on yields too. Yields were down 2%, getting back below the 8-day moving average after trying to get through here. And I remember, again, it's been rising yields this year. It's been bullish. So after a nice little breakout move there last Thursday, we've actually followed through with them actually turning back down here in the past couple of days. So will be interesting to see how we continue to move going into tomorrow and the rest of this week on yields. And then finally, commodities. We talked about how the dollar was turning up, yields were turning up, and commodities were turning up, and those were all kind of bearish for equities. Well, commodities dropped sharply today at the open, eventually rallied all day long, got back up above the 8-day moving average. So it was down today by 1%, but it was really, really down at the open of the day before making a really strong rally. So it'll be interesting to see if it continues to fill in that gap. Because again, it's been falling commodities, it's been so bullish for equities, and if we continue to, you would expect that we'd fill in the rest of this gap, and if that's the case, then we're still bullish on commodities, and still easily looking for a move back to the upside. And what could that do to this great tremendous rally we've had in equities since this peaked, right? Since that peak in commodities and the pullback, the S&P 500 has really taken off. Now the problem is, when you look at it like on this level, remove all these, and look at a comparison chart here, comparing the S&P 500, and you can see again, coming off of this high point, took a little bit of time for the S&P to bottom out. Looks like the bottom out on the 16th. Commodities kind of peaked over here on the 9th, and for about another week kind of stayed here, but really kind of started to drop there on the 17th, and that's when the S&P started to take off. And all the way to around this point here, the S&P took off with this drop in commodities. Commodities kind of rallied, rebounded a little bit, put some pressure on equities, but then we've been pretty flat on commodities going forward since that low point, and we haven't been anything but flat. In fact, we are at a higher high on the S&P compared to this one, and we are not anywhere close to that level on commodity prices, nor are we close to even breaking through these lows, right? These low points here. In fact, when you kind of look at where we're at relative to this peak, relative to this low point that we had over here on commodities that eventually produced that peak, you can kind of get an idea that we're not, like, commodities have not really been moving here, and stocks have been taking off even without commodities going one way or the other right now. Let's take a look at the sector moves here today. Remember, it's kind of it's a dollar. The dollar is our biggest mover. If you look at the sector performance just on today alone, so we go to August 15th here, and look at today, and you can see staples and utilities were your two biggest winners. Technology ended up doing okay with discretionary by the end of the day, but real estate, healthcare, utilities, and staples were all outperformers Industrials, financials, materials, and especially energy way down here were your biggest losers. And those are the reopening trade, right? That's what, again, coming off of that June 16th low point. They've been doing pretty well. A lot of these industrials and financials, materials and energy have been lagging behind, but those two have been doing really well, and you can continue to see that. Utilities and real estate have also been kind of still doing pretty good. Again, coming off that mid-June low by the end of that week there. I guess it would be more the 18th. We finally hit that low point. There we go. The 18th, we finally rallied, and you still have a strong move in real estate and utilities. But, technology and discretionary, you'd expect up 20% in that small amount of time. The S&P's up 17%. Industrials kind of matching that, and again, materials and energy lagging behind during that time frame. One stock that looks very bullish, very similar to the S&P 500 here for our trade idea today is DraftKings. DraftKings is 41% above its 30-day moving average. So it's really moved to the upside rather quickly. The highest of the year, just a little bit off of what it was yesterday. So very strong move, dark green shading and a green line. You notice we're not even above the 23% retracement yet of this decline that we've been in since September of last year. Where we started this intermediate decline, market sentiment decline. We're not even above that 23%. That's really how much potential move that this has, considering it's just kind of really getting going here. If you look at its long-term chart, the S&P is just turning into a, closing above that 40-week. That's how close we are to there. And again, we're still 23% below the PPO here, the 10 and the 40 weeks. So, this it's moving very rapidly. It has a lot of potential for some good upside moves. Here's the DMI, very strong ADX, very strong move going on there. Looking at the RSI and the CCI, again, very strong moves up above 100, up above 70 on there. If you look at the Ichimoku cloud, very strong trend, almost above 5. It's been flirting with that 5 level all day. Easily above 80. When you look at the Bollinger Bands, let's look at the bands with the Keltner channels as well. You can see, very strong band width, trading in between them, and then finally, when you look at this chart relative to these moving averages, the 30 has just crossed above the 50. You're hitting at the 200. That's about the end of the volume. So if we were able to really get above that 23% retracement, this can really take off to the upside, even if you're just in a convergence mode for most of that time, and do it slowly, because of how high the MACD and the fact that the MACD histogram looks like it may have already peaked. Even if we did that, like if the broader market's taken off and the reopening trade is what's fueling a lot of that move, as you can see here coming off of this 26th low, it's a lot of that movement's been fueled here by this reopening trade. That's an easy break through the 200-day moving average, easy break through the 23% retracement. There's no volume up above that because we were not up there for very long before coming down for most of this year. For a really good opportunity for a return that could last for a while. That's why I decided to do an at-the-money call option out to October expiration. I can roll this if necessary. Buying that, put a 50% stop order. You can see, my position size. With the 50% stop order cuts that in half, right? So you're looking at about a $500 risk, and if we go all the way out to October expiration, and we hit even just a 1 standard deviation return, you're looking at about a $1,600 reward, $1,500 reward, for, again, like I said, $500 of risk ultimately if we get stopped out. Pretty good setup for a stock that's really got a lot of potential. I mean, that's just getting to 27.28. Of course, if we get going, there's nothing stopping this all the way up to these other Fibonacci levels. You're looking at $43 eventually, no matter when that happens. Whether it's, because we'd have to keep rolling it if we needed to get there, but you're looking at about $6,000 reward. And depending upon, again, how much it would cost to roll that out to other expirations to be able to stay in it that long. But that's how big of a move it can possibly make. 3 standard deviations gets you all the way out to 50 some odd. A 2 standard deviation move gets you to 40, and you're still looking pretty good at 40 bucks. You can see it be inside of the Fibonacci retracement area, and you're getting about a $5,000 reward for $500 of risk, again, by October expiration. Alright, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. You can subscribe to us as well on marketscholars.com. Like us on Twitter and Facebook. Have a great rest of your Monday night, everybody, and we'll see you all next time.